Heiko, thank you so much for taking time to talk to us here today at the CHA conference. Great to see you. Heiko, could you tell us what is your role at Westpac and how did you first become interested in affordable housing? What's caught your attention there that means you're working in this space?
My career in banking has been credit strategy, credit policy, property lending for about 20 years. And I became exposed to community housing about 5 years ago. That was through an opportunity to create a funding package for prefabricated homes and overcoming the security challenges with that. That then led to conversations around shared equity and led to conversations around creating leasehold opportunities and exposed me to what the community housing sector was and this incredible need to get more people into homes and the outcomes for people who don't have secure housing. And I developed quite a strong sense of purpose and really wanted to make growth in the community housing sector my career, my role. And I was very lucky to have some very supportive people within Westpac who allowed me to do that. I've never had a role where I've felt more passionate about what I do. And I'm incredibly fortunate to work for a bank that lets me do what I do. Most banks, contrary to popular belief, they do have a social conscience. We know that the well-being of society, the well-being of families is incredibly enhanced if they have security of tenure in a home. There is nothing good that happens when a mum is housing her young children in a car park. That's just a travesty. So I'm incredibly fortunate to work for an organisation that passionately believes in that social equality and helping people up. Obviously, all banks are constricted by their commercial obligations, their commercial return. Those realities of being in a bank. But all the banks are really beginning to sit up and understand the importance of stabilising that housing market and growing housing opportunities. I know that most of the other banks are beginning to take interest. Westpac is hugely supportive of affordable housing and the importance of getting people into homes. Previously, my role had effectively been like a cider desk activity. It had been an adjunct to my regular role, which made it difficult to get cut through. At the beginning of last year, there was an opportunity to pitch to Westpac and say, hey, look, I think there is a huge opportunity in affordable housing. It ties in with our wider corporate message. Westpac's corporate message is together greater. Community housing is all about that. How do we create better communities, better outcomes for people together? I'd like to do this for a full-time job, please. And Westpac agreed, and I was thrilled, and I'm still thrilled to be doing a job I absolutely love.
Interested to hear your thoughts on what the challenges are for families in New Zealand who are wanting to transition out of rental and into home ownership. What are you seeing? What's the current state in New Zealand for people wanting to be homeowners?
The long-term impacts of fewer people owning homes and first home buyers owning homes or buying their first home later in life are quite stark. So we know that people who live in their own homes have better health outcomes. The houses are better quality, they're better looked after. People who have their own homes are able to use that home to leverage security to start a business, for example. In New Zealand, 97% of businesses are small business. The predominant form of security to support funding into that sector is the family home. So if first home buyers, the average age of first home buyers is now 37. So if people aren't getting into their home until they're 37, they're already over 25% through their working life before they get onto the property ladder. So that means that they're buying the house later in life. The house is also more expensive, so they're spending more of their income to service a mortgage, which means that they'll have less time to save for retirement. So you can start to see there are all sorts of long-term impacts that are going to start to congeal around this problem. And what it'll all come back to is it'll create a long-term legacy, if you will, a negative legacy that the government will have to fund because people ultimately will reach the end of their working lives, either don't have housing or don't have enough equity in their homes to support themselves. And what does the government need to do? They'll need to obviously do that with government support.
Heiko, interested to hear your thoughts from a financial perspective on some of these more complex aspects like leasehold and shared equity. If you could just unpack that for people, that would be really helpful.
Well, let's start. So shared equity and leasehold aren't products. They are equity structures. So the product that the customer gets from Westpac is a standard mortgage, but it's a mortgage that's been right-sized to the level of affordability. So they get a mortgage that they can afford to pay, but they have that future obligation to pay back the equity. What it basically looks like is, and I always use my analogy of a $100 house. If the house is worth $100 and you only have, say, borrowing capacity of $65 and equity of $10, you are $25 short to buy that house. So shared equity means that usually a community housing provider or a charity or maybe an iwi or a church will come in and they will put in that $25. They will own that house with you almost as a shareholding. They're entitled to 25% of the capital gain, and over the subsequent, usually it's a 15-year contract, your obligation as the homeowner is to pay that equity back at the market value. Now, some people say, well, that the value of that equity will go up. Yes, it will. We hope that it does within reason, but a rising tide raises all boats. So if the value of the equity is going up, the value of the borrower's equity that they've put in the home is also going up, and they have a strong leveraged upside to that piece. Leasehold is slightly different. So leasehold is where the land is not available or is owned by somebody else. These are long-term right that is put into or created, and the person purchases that right. Leasehold is one where understanding the structure and understanding the contract is critical, because poorly constructed leasehold can create long-term negative outcomes and destruction of investment value. But a well-constructed leasehold interest can be very beneficial. Again, if you can't afford a house outright, but you can afford a partial right that gives you security of tenure, connection to your community, then that has value. The fundamental problem is that the purchase of the house is unaffordable. The borrower can't bring together sufficient equity and borrowing capacity to purchase that house outright. So what they need effectively is a smaller loan. The only way to do that is either to make the house incredibly cheaper, which is very difficult in a housing market, or you start looking at innovations such as shared equity structures and leasehold structures, which I guess they chop up that housing price, the housing purchase price. They allow people to get on the ladder earlier, and then with the help of an equity partner, pay off that house in the longer term. It's important because getting on the housing market earlier, particularly in a situation where house price inflation is outpacing their ability to save, purchasing a portion of a house secures that price in the present. And then there's the future, obviously the future impost of paying off the shared equity portion, but at least the person is in a home of their own. Another area where I'd love to see more development is the idea of using leasehold structures and valuing the right to be in your own home as much as actually owning the home itself. There's no question that a leasehold structure is not as good as a freehold ownership structure, but if you can't afford a freehold ownership and you're in a rental situation, having a leasehold with a level of investment return is still better than being in a rental without any investment return. So the innovation is one of the banking sector being prepared to fund and be more comfortable with leasehold funding, being able to fund shared equity funding, and then the general public being more aware of these opportunities and more accepting of them, and then we create that demand and the opportunities.
Some of these things are quite complicated. Would you mind just giving a little bit of an explanation as to the distinctions and characteristics of shared equity and leasehold and what that looks like from a finance perspective?
If you think about why shared equity is a thing and why it exists, it's because the borrower can't afford to bring in their own equity and pay a commercial return on the remaining debt. The equity that's coming in is coming in from a third party and is going to, in a general sense, in general market sense, demand a commercial return. If the person can't pay it, then that commercial return is not there. So what the bank is looking at is how do we bring that equity into the space and create more opportunity in the space. And then, some of the other movements that we're seeing in the market, like the recent announcement by Community Finance to create a fund, and that may not necessarily be for a shared equity sense, but it's the same type of motivation to bring more equity into the into the sector to create more opportunities. But the constricting factor is the lack of equity that is able to be applied, or borrowers being prepared to take a below market return to make those housing opportunities available. The equity holders both take property market risk, so it is a long-term play, and your return is effectively that the housing market will generally rise. So you're going to get what we call the HPI, the House Price Inflation Index, as your return. So the most important piece is that as that equity is applied, it doesn't attract a recurring fee or an additional interest charge, because that then changes the nature of it and changes the way that the bank views it. The equity provider just has to take that patient equity approach. The problem with shared equity, if you will, is to get a generally acceptable market return, you need a high HPI, a high inflation in the housing market, but the high property inflation actually causes the problem that is driving the need for shared equity. So it almost becomes circular. So this is where potentially, if we can keep the housing market at a relatively calm level, the government can potentially play a role to say, well, why don't they add something to the equity return to make it more attractive, say, to a KiwiSaver provider or to private investment, so that we get more liquidity in the space, the banks can do the delivery quite comfortably, and therefore you create more opportunities. We have a partnership with the Queenstown Lakes Community Housing Trust. That is it's a general community trust focused on general housing opportunities. That was our first client. In fact, they are the developers of the lease structure. The key with leasing is really understanding the legal documents and the legal requirements, because as I said earlier, poorly constructed lease can be a terrible outcome for borrowers. That's part of what I do in my role, is I will review leases and make sure that the critical pieces that I want to see and that protect the borrower are in place. My philosophy being that if the borrower is protected, then the bank is protected. Putting the borrower first is the way to do that. Often banks will say somebody who's getting into a shared equity structure or a leasehold structure is vulnerable. My argument was, if all they're getting is a smaller loan and they have a strong job, they've got a good education, that doesn't necessarily make the borrower vulnerable. So we don't need to wrap an amazing amount of cotton wool or almost discard the opportunity because we believe there is a vulnerability in the borrower. We can treat the borrower as a completely normal borrower in our system, and I use the word normal quite deliberately because they get all the rights, all the benefits, all the pricing of a standard mortgage product, but they just get a smaller mortgage. So that's the power of that leasehold structure and that shared equity structure. It makes that initial investment price cheaper, which means it sets the entry level of the entry price into the market at that point, and then the future obligation is just to pay out, in a shared equity sense, is to pay out the future equity. In a leasehold sense, you just have to pay the ongoing ground rent. The key with the ground rent, going back to that earlier question around the key points of it, is particularly making sure that the term is very long. Most leases in New Zealand and the UK as well, about 21 years. We deal with leases that are usually 50 to 100 years long, and there's limits sort of to how that ground rent can be reset. They're usually capped at an index like CPI or just at a set percentage. That then protects the borrower, because you don't want the ground rent review to outpace the borrower's income. That's the key piece.
This is a little bit of a challenging question, because I know you're within a large respected bank. What is the banking sector? What could the banking sector and the government do, in your view, having seen what you've seen, doing the work that you're doing to help us to move the dial on getting more whānau out of rental poverty and into home ownership?
The housing market problem, the people who are wanting homes, amounts to the hundreds of thousands of homes. I mean, the entire participant group at the conference put together have probably only put together 10 to 15,000 homes. We're not even scratching the surface of the problem. It needs a bulk approach to get near the solution of getting more people into homes. the house price income multiple is a factor of your level of income to the price of the house. So either the price of the house has to come down or incomes have to come up to bring that multiple back together. Do we want house prices to come down? The answer to that is, well, we do, but we don't want them to come down suddenly, because a collapse in the housing market creates its own problems. It creates problems for the people who are living in the homes, who invested their life savings in the homes. It creates problems for economic stability. So the wind out of house prices needs to be slow, or house price inflation in future needs to be at a very modest level. I mean, going back to incomes, the inflation in income needs to be slightly higher than the rate of inflation for housing, and then you'll see a closing of that gap. The other way of helping people into homes is going back to what we discussed earlier. We change the way that we buy homes. We fractionalize it. We take on different models. We get more creative in terms of how people can own homes. We get away from that New Zealand sort of approach of I have to own the home outright. This is the only way to do it, and I'll stay renting until I get there. There are different avenues to get into home ownership, and it's just a matter of raising the awareness of those possibilities for people. From a banking perspective, it comes back to how do we attract more funding in the space? I mean, there's been discussion at conference today. How do we attract the KiwiSaver providers who are, they're getting regular injections of funding from their investors? How do we make shared equity, for example, or community housing attractive for that sector to invest? We're effectively trying to almost dislocate the requirement of government funding and make the sector attractive generally. I think the government will always have a level of role to play. I think the answer is showing the government that partnerships with the private sector can help them spend their community housing dollar much more efficiently. I mean, Minister Bishop yesterday said they're spending $5 billion a year on housing. I mean, he wrote out a stat, I think it was 3 transmission gullies or I mean, I wrote it down and I just remember my hand was almost shaking with how scary that was. If we can create greater efficiencies in how the government spends its dollar to support people in homes, we can create better outcomes. But it's a private sector, public sector partnership. Banks aren't these big, horrid institutions that just want a straight financial return and are driven by corporate greed. Banks have huge motivation to affect positive societal change. I mean, I have tremendous breadth in my role to be able to assist CHIPs to structure their operations, to advise on what would work in a banking context, what to avoid. I have freedom to provide my services to CHIPs for free. The banks want to help. So maybe the key message is to a CHIP who is thinking about setting up a scheme, or to people who are thinking about shared equity, come and talk to the bank. We are here to help. We're motivated to help. As I said, we don't charge for that help. And whether it's a program that is doing one house or whether we can do 100 houses, we are here. We want to see those outcomes. If I was to have Minister Bishop sitting in front of him, I would say, can we work together? Can we work together to solve this problem? Because the government, is very fluid in its strategy. I mean, I do applaud the government strategy regarding pulling people out of emergency housing and into IRRS. But can we have a wider conversation about the other parts of the housing continuum? Can we talk about people who don't have intergenerational wealth but are still earning relatively good salaries but can't afford a house and are stuck in renting? How do we help those people? Because if we don't help them, they're going to make their own choices and leave New Zealand. And what does that mean? There are lots of long-term economic outcomes that start to manifest and congeal around the problem when you can't have or can't obtain housing security. I mean, it's fundamental in the hierarchy of needs. Rather than just focusing on the banking aspects of that, the key lever that the government could pull, and it's really just one lever: consistency. Consistency of strategy, consistency of approach. We had a speaker this morning who quite rightly said that the construction market doesn't respond on a dime to a change in government policy. It takes years to be able to do that. government policy around housing it changes every sort of 2 to 3, maybe 5 years, which means that CHIPs struggle to plan, they struggle to fund, banks lose confidence, the construction sector takes time to gear up to be able to build the homes. That lack of consistency fundamentally is the problem. The government at the moment obviously is focusing, and quite rightly, on getting people out of emergency housing, getting them into IRRS and affordable rentals. Those are good outcomes, but they shouldn't focus on those outcomes at the exclusion of other points on the housing continuum. They should also be focusing on how do they get people into home ownership? How do they allow people to be fully independent and grow their own wealth and be completely independent in future? Someone who's in an IRRS situation, they're still renting, they're still paying their income out to an organisation and not getting an equity return or a capital return for that investment. So renting is fantastic in the sort of the short to medium term. In the long term, it's trying to give more affordable ownership opportunities to people, to give them that tie to their community from a whenua Māori perspective, iwi Māori land perspective. Helping people come back to the whenua, be close to the marae, create that connection. You don't get that through renting. You get that through ownership. But certainly, come back to that point of long-term consistency of approach would be all it would take, rather than politicizing housing. Turning homes into a vote grabber is just not the right outcome. Sure, I know that there have been criticisms of certain government agencies. There have been reviews of certain government agencies. If there is waste in the system, absolutely eliminate that, because we're not big enough to be able to cope with that. But if we can create an efficient model, and a model that we all agree on, then there is a huge benefit to longevity of that. And that's really where the sector, together with CHA, can play a really important role, to come together and say, this is what we need. Put this particular model in place and keep it there. Let us plan, and we will deliver this many homes. That would have huge benefits to the sector. So yeah, 2 key messages. The bank is here to help, and we would love to work more with government on how do we create sort of a market solution. But if there was a way of having future certainty, of allowing CHIPs to plan, allowing the banks to understand the models and fund into them. I mean, we're creating long-term relationships with CHIPs who are wanting investment in their housing portfolios. It doesn't work on a short-term, policy uncertainty basis.
Heiko, thank you so much. It's been really great talking with you. Appreciate your perspective. We need the big banks like yours at Westpac sitting at the table, working with our members constructively. So just very grateful. Thank you.
No, it's been an absolute pleasure, and it's very easy to talk about a subject that I am super passionate about. So I hope we have many more conversations about it.